Are we live? Are we live? Yes, I think we are. Yeah. Hi, every good afternoon. So, this lecture is on the Unacademy Chartered English YouTube channel. Some small information about this iconic program. It's a special program for CA final students. One-to-one mentoring with one-to-one doubt solving, one-to-one mentoring with our professors, and many benefits. You can also avail of the test series. You can see a code on your screen. You can use that code. Subscribe for the iconic subscription. You get a discount also. So on the Unacademy's website, you'll get all the information. So just a small type of a trailer for uh, this whole program. Now, what's the agenda for today's class? Today's class, we are talking about Finance Act 2021. So we are talking about students appearing for May 2022 and November 2022 exams. Section number 10 has many clauses, and the Finance Act 2021 has made many amendments in Section 10. Section 10 does not have subsection numbers. You call it as clause. You will observe in the Income Tax Act at many places, sometimes it is subsection 1, sometimes it is clause 1, subsection 5, clause 5. So how do you come to know? There is no clear-cut guideline for it, but a small technique that you can observe, a small pattern that you can observe. If the section is a kind of a list, then it is clause numbers. Section 10 is a list of incomes which are exempt. List of incomes which are not to be included in the total income. So you have clause numbers. Section 36 PGBP has subsection 1, and thereafter there are clause numbers, because in the clause numbers there are list of deductions allowed. Section 32 has subsections. Section 45, section 143, they are all having subsections. If the section that you are studying is a list, so it has clause numbers. Section number 2, definitions, a list of definition, so clause number. Section 10, a list of exemption, so clause numbers. Now, in section 10, there are many amendments introduced, and today from 12 to 1:30, and a second session slotted today only in the afternoon from 3 o'clock to 4:30, we will be discussing certain amendments in section number 10, which are relevant for May 2022 and November 2022 CA final exams. Chalo, let's get into it. First clause of section 10, clause number 5. What is 10 clause 5? So 10 clause 5, just give me a second. Yeah. Section 10 clause 5 talks of leave travel concession. Head of income under which we cover this, salaries. Now, frankly speaking, salaries is something that is CA intermediate topic, not CA final. CA final salaries as a head of income hardly comes up in your paper. But then there is an amendment introduced. So it's better that even at CA final level, we are aware of the amendment which is touching the chapter of salaries. Although salary as a head of income rarely comes in your paper, but 10.5 is something that we should be aware of. You could probably be asked a question as an MCQ, or it may be a small theory question that is asked. This amendment is equally applicable for CA intermediate students also, but then CA final students also, please ensure that you study it. What do we know about this? What are we already aware about this? We are already aware that the traveling cost that is borne by the employer. Who is on leave? The employee is on leave along with his family. And the term family has been defined in section 10.5. He is on a leave, he is on a holiday. So leave travel concession that the employer provides to the employee will get an exemption for the traveling cost that he has incurred. So employer has given the concession, the financial benefit, the cash benefit to the employee, and employee is spending it. 10.5 gives you that exemption. Along with 10.5, the detailed provisions are there in rule number 2B of income tax rules. Now, this is if you incur traveling cost, only then you'll get an exemption. Also, the rule 2B says you have a block of 4 calendar years, and in a block of 4 calendar years, any two journeys, you can claim them as exempt under section 10.5. You can claim any two journeys as exempt. You can carry forward any one, but only one unutilized exemption to the next block. To the next block of 4 years, you can carry forward this exemption. So in the next block, you will get an exemption for 2 plus 1, 3. Now, these are all the basic provisions. But 2020-21, the period when lockdown was imposed, flights were suspended, both domestic and international flights. So as an employee, going on a holiday with my family was not possible. But in my salary package, I can still have leave travel concession. So I will get the cash, I will get the money from my employer. Exemption depends on the traveling cost that is incurred by employee, but there is no traveling cost because for a major part of the year, there was this lockdown situation. Even when the lockdown was lifted, flights were still suspended. So how does an employee achieve the traveling? And therefore, he does not get any exemption. Realizing this, 10.5 was amended. The amendment was introduced as per our budget, Finance Act 2021. But the amendment that is introduced, that was introduced applicable for assessment year 21-22. That means previous year 2021. If for that assessment year you have received cash assistance, then you will get an exemption even when you have not traveled. Even when you have not traveled, you will still get an exemption, subject to fulfillment of such conditions, and you have to incur some expenditure out of that amount. So employer has given you the leave travel concession amount to the employee, and as an employee, you are required to spend this amount. If you spend this amount in a particular manner prescribed, then you will get your exemption. Now, who is prescribing all of this? Rule number 2B is prescribing. In rule number 2B, a new sub-rule was inserted, sub-rule number 1A. In sub-rule 1A, it says that you will get an exemption if you avail any cash allowance from the employer. So employer gives you the leave travel concession, the monetary payment that you get. Then you're not incurring any traveling cost because it's not possible to incur traveling cost. Then the amount which will be exempted shall be not exceeding, this is your formula, not exceeding 36,000 rupees per person for the individual and family member, or 1/3 of the specified expenditure, whichever is less. So the basic formula created, 1/3 of the specified expenditure or 36,000 rupees, whichever is less. Which means in simple terms, the maximum exemption that I can avail is 36,000. If I spend more than 36,000, in fact, if one third of that specified expenditure is more than 36,000, then the exemption is restricted to 36,000 only, which means my working will look something like this. Leave travel concession. Let me put it up in a different page. My working is going to look something like this. Leave travel concession received from the employer minus exempt under section 10(5) read with rule number 2B sub rule number 1A. One third of the specified expenditure or maximum 36,000, whichever is less, and this amount that remains, this is going to be taxable for the employee. So now the question arises, the rule is saying specified expenditure has to be incurred. What do I mean by this specified expenditure? Let's understand the meaning. Specified expenditure means expenditure incurred by an individual or a family member during the specified period. During the specified period. Now, what is the specified period? This is the specified period. From 12th of October 2020 to 31st March 2021. So you have to incur this expenditure in this period. You have to incur this expenditure on what? You have to incur this expenditure on goods or services. You have to incur this expenditure on goods or services which are liable to tax at an aggregate of 12%. Goods and services are liable to tax. That means I am talking of GST, which is liable to GST at 12% or above. So all those products where the GST imposed, products or services where the GST imposed is 12% or more than that, on those goods and on those services, expenditure has to be incurred during this period. That is called as my specified period. And I have to ensure that the goods are purchased or services are procured from GST registered vendors or service providers. So here basically what the act wants you to do is, let's say an employer gives to the employee leave travel concession of say 90,000. Now I as an employee cannot travel anywhere. So this 90,000 can become taxable for me. But to a GST registered vendor, if I make a payment, if I incur a specified expenditure 90,000 and I make a payment for goods, so I'm purchasing goods from a GST registered vendor, and this GST registered vendor, what is he going to do? He is going to collect GST of 12% or more, and that GST will be thereafter paid to the government. And then for me as an employee, one third of my specified expenditure, one third of 90,000, that is 30,000, sub or a maximum of 36,000. Out of the two, whichever is lower, that means 30,000 will be my amount exempt under section 10(5), which means for the employee, the working will look like leave travel concession received 90,000 minus exemption under section 10(5), 30,000, and it means the balance 60,000 will be the taxable portion of leave travel concession. Of course, some things which can be easily understood. This expenditure that I'm incurring, specified expenditure, this expenditure that I'm incurring should be incurred between 12th October 2020 to 31st March 2021. So if this expenditure is incurred prior to 12th October 2020, then it is not eligible for this exemption. Also, if I use this, for example, this 90,000 rupees and purchase some goods or take some services where the GST is below 12%, again, it is not covered as specified expenditure, so no exemption is available. So there are some other things also to read. First, we'll read the whole thing, and then we'll analyze something extra, then we'll talk something additional. You got to fulfill some conditions. Subrule number 1A says that 1/3 of the specified expenditure or maximum of 36,000 will be your exemption, subject to fulfillment of the following conditions. Okay, so what is this now? Condition number 1. The individual has exercised an option to avail an exemption under second proviso to 10 clause number 5. What is the second proviso? This is your 10 clause number 5. Initially, it tells you if you travel in India, then you will get exemption. The first proviso says that your amount exempt cannot exceed the traveling expense incurred. Fine. This is the second proviso. So this is the new thing inserted. And we are saying in Income Tax Act, section number 10, clause number 5, second proviso is what I am availing. So as an employee, I am using this option of exemption under 10(5) as per the second proviso. Subrule number 1A is prescribing that as a condition. I am availing exemption under this second proviso in lieu of the 10(5) exemption in respect of one unutilized journey. That means this is in lieu of the one unused journey that I have carried forward during the block of 4 calendar years commencing from calendar year 2018. So 2018, 19, 20, 21. From 2018 to 2021, in this block of 4 years, I have one unutilized journey, and instead of that unutilized journey, I am availing this exemption. Second condition, payment is made to a registered person. Who is a registered person? Registered person means section 2 clause number 94 of Central Goods and Services Tax CGST Act. It's a registered person to whom I am making a payment during that specified period. We are already aware what specified expenditure is and what specified period is. Third condition, payment should be made in one line, I can say, or in one word I can say, through prescribed modes. We are already aware at various places in the Income Tax Act, account pay check, account pay bank draft, electronic clearing system, and those prescribed modes as per Rule 6 ABBA, NEFT, RTGS, IMPS, credit card, debit card, wallet payments, Aadhaar Pay. Those are the prescribed modes, and I am following those prescribed modes. And I'm making a payment of that specified expenditure. So cash, bearer, check, cross check, not permitted. And I have to obtain a tax invoice, which is the evidence that yes, I have incurred the expenditure. Then, subject to these conditions, one, I must make the payment to a tax registered dealer. I must make a payment to a tax registered dealer. It should be of specified expenditure. It should be during the specified period. It should be through the prescribed modes of payment. And I am availing this exemption in lieu of that one unused journey that I have. Then the explanation number 1 says what is specified expenditure, what is specified period. And then explanation number 2. This is a clarification. It is hereby clarified that if the amount received by or due to an individual as per his terms of employment from his employer in relation to himself and member of family, the amount received as per his employment contract in connection with this specified expenditure is in excess of 36,000 per person, the exemption under this rule shall be restricted to 36,000 or one third of the specified expenditure, whichever is less. That's something that we saw. Okay, if I'm getting 90,000 rupees, then my exemption is maximum restricted to 36,000 or one third of the specified expenditure. So it is just a clarification, as I said. Subrule, then explanation number 3. On 12th of October 2020, Government Department of Expenditure, Ministry of Finance, they came out with this clarification explaining the provisions, how it's going to work. So explanation number 3 says that this clarification and any subsequent clarification will all apply to this exemption. And the last amendment introduced in subrule number 1B, if you are taking exemption under 10.5, then as if for the words two journey, one journey has been substituted. So instead of two, you will get one ka exemption because one you are claiming here. Now this provision has been okay. One more explanation which I kind of missed out is that you can't claim double exemption. If an individual is claiming exemption under this 10.5, no exemption shall be allowed to any other individual in respect of this expenditure. So if I am the individual, yes beta, Punanjay, you can watch this. This part 1 of the video, whatever I'm doing, yes, definitely you can watch it. All the amendments that I'll be discussing in this video will be equally applicable to CA intermediate also. So definitely, yes, this video is equally relevant to you. You can definitely watch it, no problem. So if you claim an exemption, then any other individual cannot claim an exemption for the same expenditure. So it's like if I am the employee and my wife is also an employee working in two different companies maybe, and we jointly purchase a product where GST applicable is above 12%. Like for example, I think air conditioners are covered by 28% GST. Laptops are covered by I think 18% GST. So I can claim an exemption for the invoice, the laptop purchase or the AC purchase, but then the same exemption cannot be allowed to my wife under her computation of salaries, which is kind of logical also. This amendment was criticized by various tax experts, by various newspaper articles also, and to be very honest, they are correct also. The amendment is drafted a bit illogical, if I may say so. The period that you are talking of is November 2020, sorry, October 2020 to March 2021. You just go into flashback. This was the time when we were just recovering from the first lockdown. The first lockdown had probably ended March, April, May. Businesses were still not that great, and maybe in this period, traveling had probably opened up, not as much as it is today. Businesses are slowly growing. The second wave was not still. Second wave came about April or May 2021. First wave was there in this whole span, 2020-21 financial year. People were having cash flow problems. And now, if as a person who is doing a job, I am getting leave travel concession, I would rather want to preserve that money with myself because I have various personal expenses, personal liabilities, many payments to make. And I would keep that money with myself, pay tax as per slab rates, not take this exemption. It is very sensible to not claim this exemption. The reason being, the government is expecting me to spend this money, but is not giving me the full exemption. It is only giving me an exemption of one third. And that too, it is putting a overall cap of 36,000. Like you can observe now in my example itself, even after spending 90,000 rupees, I'm getting an exemption of one third only. 60,000 is still becoming taxable, on which I have to pay tax. So government is getting its own GST. I am only getting one third of exemption. Balance amount is still becoming taxable, and I'm paying income tax to the government. Then I might as well pay income tax to the government on full 90,000 and keep the balance money with me. I'm not talking like a tax guy. Now I'm talking practically like an individual who is an employee. Instead of having a cash outflow of 90,000, and still out of that 90,000, 60,000 is becoming taxable. So I have to pay 90,000 to that registered person, pay GST on it, and pay income tax on that 60,000. And that too at a time where everybody is, scrambling for funds. Why should I avail this? A better way of drafting could have been the whole expenditure is exempt. Government anyways has got GST, na? So why do you want income tax? Give benefit to the employee, or maybe give an unconditional exemption for a year, na? You are inserting this exemption only. You are inserting this exemption for AY 21, 22. For 1 year, give exemption to leave travel concession. Or don't make the employees spend one third. Give a flat exemption, na? 90,000 rupees, 40,000 exempt, 50,000 exempt. Like in the head of salaries, uh, exemption is allowed for 2 children, beta. But Punanjay, that 2 children is when you travel, when you are doing the traveling. So here, you are not doing any traveling, na? You're just incurring the expense. So that 2 children ka restriction, I don't think will be applicable here. That restriction is applicable only if you incur the traveling cost. But the point that I was referring to was, like salaries has a standard deduction of 50,000. You could have given a standard exemption here for a single year. Instead of making the employee spend the money, you are getting your GST. You could have alternatively, option one, given a standard exemption, balance amount taxable, you would get your income tax. Or option two, you want your GST, okay, tell the employee whatever you spend is exempt. And if you remember your salary is head of income, there are certain allowances in 10 clause number 14, which says if you spend the allowance, it is fully exempt. You could have done it here also. Spend the leave travel concession, take full exemption. Government has already got the GST, no? Many newspaper articles, many tax experts criticized this, and the criticism is not absolutely wrong also. Then the natural question that should arise, a student who understands why this exemption is not correctly drafted, a student will start thinking, okay, then who will avail of this? Who will avail this benefit? They might as well, like I was saying, instead of going for this 10.5, I would have said, no, I don't want to take exemption. I'll pay tax. This exemption, this amendment might be helpful, might be useful to those individuals who, in any case, were going to purchase those goods or going to take those services where the GST is 12% or above. Again, Punanjay, if you remember what you are saying, as per 115 BAC, 1014 will be included in total income. I'll rectify you on two things, beta. 115 BAC is optional, not compulsory. So you can still choose as a salaried employee not to go for 115 BAC. Number two, 1014, certain allowances are still exempt even if you go for 115 BAC. And those allowances include expenditure based allowances also. So 115 BAC getting introduced into this discussion will not only complicate things, but it is not in the context. 10.5, this exemption that we are talking of is saying that you are claiming this exemption in lieu of that one unused journey. So you can still not claim this exemption, and when traveling opens up, you can take the exemption of actual traveling cost. This amendment is relevant for those employees who anyways were going to incur the cost of a laptop, maybe let's say for work from home, air conditioner to be installed in the room. No problem, beta, no problem. So they were anyways going to incur the cost, and if they were going to incur the cost, they might as well take the tax benefit also, whatever benefit is available. But somebody who does not have to incur all those costs, then they would prefer to pay full income tax on the leave travel concession received, not go for this exemption. Here, by availing the exemption, government has just drafted it in its own favor, and therefore many people criticized it also. So this is your first amendment, section 10, clause number 5, leave travel concession. You have to incur specified expenditure, you have to buy goods or take services where GST component is 12% or above. But you have to do it in this gap, October 2020 to March 2021. Chalo. Moving ahead. Okay. Another amendment. This will also affect CA final and CA inter students both. Statutory Provident Fund, Recognized Provident Fund, and Public Provident Fund. When you receive money on retirement, you get exemptions. There are 4 provident funds that you have. Sorry. Four type of provident funds that you have. Statutory Provident Fund. If you are an employee working for government, Statutory Provident Fund, section 10(11) gives you exemption. Recognized Provident Fund. If you are a non-government employee and your provident fund is approved, is recognized by the Commissioner of Income Tax, then the lump sum money was exempt from tax under 10(12). If you are doing a job where the provident fund is unrecognized provident fund, then there is still the same, no exemption allowed. In the sense, the retirement money, the retirement lump sum corpus that you receive is chargeable to tax, except for that one small employee's own contribution, which was exempted because you have already paid tax by not taking a deduction. But broadly speaking, unrecognized provident fund lump sum money is taxable. And then you have public provident fund. Public provident fund is for the benefit of general public, and here also we used to get an exemption under 10(11). I am talking about the lump sum amount received, lump sum amounts received on retirement, on termination. 10(11), 10(12) lump sum amounts. Now, amendment that is introduced is in 10(11) also and 10(12) also. A proviso is introduced. The provisions of this clause meaning which clause? Clause number 10, section number 10, clause number 11 shall not apply. So you will not get exemption. 2. The income by way of interest that is accrued during the previous year in the account of the person, to the extent it relates to the amount or the aggregate of the amounts of contribution made by that person, exceeding 2,50,000 rupees in that fund, computed in the manner as may be prescribed. No method till date has been prescribed. So here what we are talking of is interest that is accrued in the fund. 1011 talks of statutory provident fund and public provident fund. Interest that is accrued in the fund during the year, to the extent it relates to your own contribution, the account holder's contribution, and account holder's contribution exceeds 2,50,000, then that interest on that extra contribution is no longer exempt under 1011. Okay, let's try and decode this via a numeric example. Say for instance, an employee contributes 50,000 rupees every month to the statutory provident fund, which means his own contribution for this year is 6 lakhs. Now we are saying out of this 6 lakhs, let us reduce 2,50,000. Reduce for calculation purposes. Remember that the entire money is into the fund. So we are not touching anything into the fund. We are not talking about the corpus of the fund getting changed. No. What is the extra contribution over and about 350? So this extra contribution is what we are talking. Now, what will happen? Interest on 6 lakhs will be credited to the statutory provident fund. This will be a certain amount. But out of that interest on 3.5 lakhs, that interest which is credited to statutory provident fund on that 3,50,000, this amount, this is the amount for which section 1011 is no longer applicable. 1011 is not applicable, which means this interest will be chargeable to tax. Now it is interest on your own contribution. It is interest on your own contribution. So you are going to pay tax on this under the head income from other sources. Your own contribution is the principal amount. No exemption is available. It means this interest will be taxable for you. Unfortunately, I won't say unfortunately, let me rephrase myself. So far, the method to compute interest is not prescribed. So maybe if I can think of a method, a very simple mathematical thing, nothing great. Let's say this interest is credited at the rate of 8% per annum. So we would say 8% per annum on 3,50,000 will be chargeable to tax. What will be credited into? Punanjay, that is what I clarified. Let me speak of that again. 6 lakh rupees is not becoming taxable. Section 10 clause number 11 is not making the principal amount taxable. Section 10 clause number 11 is making the interest component taxable. As an employee, when you are contributing 6 lakhs, it is like making an investment. You are not told to pay tax on 6 lakhs. You are not told to pay tax on that 3,50,000. No. On the interest on that 3,50,000, that interest is being brought to tax now. Section 1011 ka exemption is not available for the interest that is accrued. Look at this. The provisions of this clause 1011 shall not apply to income by way of interest accrued. Contribution is not subject to tax. The interest is being charged to tax. Now, the issue that can arise here. One small issue that can arise. Number one, when do you get the exemption under 1011? 1011 ka exemption is any payment made. Look at the section. Any payment made from a provident fund to which the Provident Fund Act 1925 applies. Provident Fund Act 1925 means statutory provident fund, or any other provident fund set up by the central government and notified in this behalf. This is talking about public provident fund. Any payment from a provident fund. When do you get payment from a provident fund? You get payment from a provident fund on retirement from your job, or when you quit the job on termination. That means this exemption is availed by an employee when he receives the money. But look at the problem. The word used is interest accrued. Interest accrued. When is the interest accruing? Interest accrues every year. This is something that the government has to clarify. In a section which gives you exemption at the time of retirement, government has introduced a proviso. But in the proviso, they have used the word interest accrued. So will this interest be taxable in the year in which it is accrued? Or will the interest be taxable totally at the time of retirement? There is no clarification from the government. In the initial part of the section, it says any payment received by an employee, any payment made by PF received by employee, any payment. So it is on actual payment receipt basis. But the proviso says interest accrued. So this is something that the government still has to clarify. Another thing. Now we got to understand that certain interest component is becoming taxable for the employee. Now, the moment it becomes taxable, people will start talking of TDS liability. So, in this example of mine, when the statutory provident fund will credit interest into the employee's account, payment or credit whichever is earlier, is the criteria for TDS. Now, this interest, which is on that extra contribution over and about 2,50,000, that interest on extra contribution is taxable. So now it becomes the duty of that statutory provident fund that it will have to deduct tax. On interest, you will deduct tax under section 194A at the rate of 10%. If the interest is above 5,000 rupees, you will have to deduct tax at 10%. Definitely, yes, the interest is going to be above 5,000 rupees because your contribution is 3,50,000. On that, the interest that will be calculated is going to exceed 5,000. So TDS will have to be deducted at source, which means a certain part of your interest will be deducted and deposited with the government. Only the balance amount will be credited, will be there in your PF. That means in the next year, you will have again a contribution for the next year. Check whether it is above 2,50,000, and on that excess, next year ka interest will become taxable. But even year number 1 3,50,000 of my example is still in the fund on a cumulative basis. Even that will generate interest income. So if you think about this, what will now happen is that in year 2, contribution of year 2 minus 2.5 lakhs into the rate of interest. This will be taxable. And contribution of year 1, which was in excess of 2.5 lakhs, is still there in the fund. And on that also, you are getting interest on compounding basis. So even this will have to be added. And this will be the taxable interest component. We will assume that interest which is received in the previous year is taxable. Onanje beta didn't understand what you mean. Can you elaborate it, please, beta? So this will be another complication that you will have to take care. Likewise, if you think of year number 3, accumulated amount over and above 2,50,000 of year 1, accumulated amount of over and above interest accrued in previous year is taxable, sir, as per our assumption. Okay. So you are talking about the interest over and above the contribution of 2,50,000. Am I understanding you correctly? So that interest is deposited into the fund. It has accrued in the fund. And you are saying that the interest which is received in the previous year is taxable, accrued in the previous year. That was your next message. So if you are thinking, tell me at the end if I've understood your doubt properly or not. Huh? I am interpreting your doubt. Tell me if my interpretation is correct or not. The interest that becomes taxable as per this proviso is becoming taxable every year. Even though I'm not receiving the money, even though I'm continuing my job, I'm going to get the lump sum amount on retirement. That lump sum amount will be exempt. But during service period, every year, on the contribution, which is about 2.5 lakhs, on that extra contribution, the interest accrued is charged to tax every year, even though it is not received. That is what you mean, beta? Perfect. So year 1 ka interest became taxable in year 1 because of the words interest accrued. But it became taxable. The entire interest is still there in the fund. The entire contribution is also still there in the fund. So year 1 ka contribution will be in the fund 6 lakh rupees. Then 6 lakh minus 2.5 lakhs. 3.5 lakhs of year 1 will earn interest in year 2, in year 3, in year 4, in year 5. So every year, This type of cumulative calculation will have to be done. For the sake of clarity, I'll mention something. So there is no confusion. This rate of interest that I am referring to, this is rate of interest of year number 2. Then on second year's contribution, which is about 2.5 lakhs, interest taxable. On the first year's contribution, which is about 2.5 lakhs, and the money is still in the fund, there will be interest earned on the first year's contribution also. So interest on the first year's contribution is also accrued in the second year. Interest on the second year's contribution is also accrued in the second year. That means as per that proviso, interest accrued during the previous year, to the extent it relates to the amount or aggregate amounts of the contribution exceeding 2.5 lakhs made in any previous year. So like this, cumulative working will have to be done. The words used are any previous year. And so interest component will become taxable. That means if you have really understood that things will go on a compounding basis, it is this second year ka interest, second year ka total amount, which will be liable to TDS provisions. Yes, the government should come out with, number one, the method of computation. Number two, the government should come out with an appropriate clarification about when should it be taxable. Should it be taxable every year? Should it be taxable only at the time of retirement? Logically, the interest component should be taxable every year. So that every year, employee, you will include it in your salary, you will include it in your IFO's head. The Provident Fund will deduct tax at source. You can get a credit of TDS from your every year's tax. It does not make sense to postpone the entire amount taxability at the time of retirement. Lump sum amount give exemption at the time of retirement. But every year the interest accrued should be taxed every year, so that there is no complication in TDS, there is no complication in computation of income. And this type of amendment is introduced for recognized provident fund also. 1012 talks of recognized provident fund, and the same amendment is drafted in 1012 also, which means all three provident funds, statutory, recognized, and public provident fund, contribution of the account holder, in excess of 2.5 lakhs, and on this contribution, whatever is the interest calculated, this interest will be chargeable to tax. The head of income for this has to be income from other source. A clarification put up is, and even this clarification is put up in both the clauses. If the contribution by such person is in a fund in which there is no contribution by the employer of such person, then this proviso will work as if 2,50,000, the word 5 lakh rupees has been substituted. That means if the employer does not contribute into this fund and you are the only person contributing, then contribution minus 2.5 minus 5 lakhs. Only that will be treated as extra contribution, and on that extra, you'll have to calculate interest and pay tax on that interest. So that means that if employee and employer both contribute 2.5 lakhs, over and above that, extra contri, on that extra contri, interest taxable. If it's only the person contributing and there is no employer contributing, best example, PPF. If employer does not contribute and you only contribute yourself, then contribution above 5 lakhs, that extra contribution into the interest rate will be treated as taxable. There is no reason as such why this exemption is withdrawn and income has become taxable. Maybe the government wants some income tax inflow. Maybe the government wants to encourage people to invest elsewhere and not to just deposit their money into the provident fund. Beyond a point of time, it is difficult to figure out the logic for this, but yes, this is how the provision is going to work. 10 11 and 10 12. Okay, so the last exemption for this lecture. This is something important. Thank you. And you can easily be sure, you can predict that this thing will appear in your question paper. How it will appear in your question paper is difficult to predict, of course, but you can have a reasonable amount of confidence that yes, 10 clause number 10D ka amendment will be part of your paper. See, what is 10 clause number D ka amendment? This amendment talks of ULIPs, unit linked insurance policy. Before we even start getting into the amendment, there is something that I need to speak, and I'm sure you guys would be aware about it also. There is something that I need to speak about the general provision. Unit linked insurance policy. What is it? Unit linked insurance policy is basically a life insurance policy. But the difference is that it is linked to units, which means you get units of ULIP, like you get units of a mutual fund, and your insurance amount will be the NAV, net annual value, sorry, net asset value of those units multiplied by the number of units that you have. This insurance amount will be given to you at the time of death, or you can withdraw it. That means you can redeem your units like you redeem a mutual fund unit. You can redeem these units. The difference is that a traditional life insurance policy has a fixed amount of sum assured. If death happens or if the term of the policy gets over, we will give you a fixed sum assured. In that, LIC can give you some bonus also, but bonus is optional. It depends on the policy that you take, the plan that you take. But your sum assured, sum promised is a fixed amount. In ULIP, it is not a fixed amount, it will fluctuate depending on the NAV of the units. And that is your insurance amount. But at the end of the day, it is still insurance amount. So Income Tax Act says that insurance amount is going to be exempt under 1010D. All insurance money, life insurance money, exemption is available. Now government observes that there are certain policies, such type of ULIP policies, these unit linked insurance policies, which actually are not insurance policies, but they are investments. It's an investment instrument, but it is insurance policy, meaning the person who is making or who is buying such a policy, his intention is to invest it into those units which are listed on the stock exchange and on money from investment. But it is designed as an insurance policy, and therefore I want to take exemption. Now government wants to stop this, and so government has created various amendments. But the bottom line of all these amendments is, okay, one thing. I am going to target high premium unit linked insurance policies. And what do I mean by high premium unit linked insurance policies? The premium that I pay for any year exceeds rupees 2,50,000. Now let me clarify something. I am an assessee. I purchase a unit linked insurance policy. So, on the other hand, this is an insurance company. I will pay a certain amount as premium. ULIP is in inter part. Didn't understand better. Just give me a second. Are you trying to ask के ULIP वाला amendment is included in CA inter syllabus, something like that? Just give me a second. I'll give you an exact answer. If you refer, wait, let me just clarify everything. 214.9. Okay. If you go to the institute's website and you download your study material for CA intermediate, paper 4 taxation, CA intermediate study material, you will find in the income tax study material there is something called as initial pages. And if you download that PDF, in that initial pages a list of sections are mentioned which are not applicable for CA inter syllabus. In that list of sections which are not applicable for CA inter syllabus, 1010D is not there. The list of exclusions, 1010D is not there. That means 1010D is definitely part of your syllabus. And so if 1010D is part of your syllabus, it will mean that even the amendment will be part of your syllabus. So the assessee purchases a ULIP, pays premium, and for this premium, the insurance company is going to allot units. This will be done every year. Now, the Act is saying that this premium should be greater than 2,50,000, then such a ULIP is no longer covered in the exemption. Now you will pay premium every year. So every year you will be allotted units. Just keep this at the back of your mind. You will pay premium every year, and every year you will be allotted units. This is what is called as a high value ULIP policy, unit linked insurance policy, where the premium is about 2,50,000. So this is actually not an insurance policy. You are trying to make an investment, and in the disguise of insurance policy, you are trying to claim exemption. Now, in section 10, clause number 10D, provisos have been introduced, which deny the exemption. It's a bit technical for a CA inter student. So CA final students can read it from the act and understand it. CA inter student reading it from the act will be a bit difficult. So you'll have to focus on the explanation that I give you, which will help you to understand the simple version. First proviso, first amendment, that means fourth proviso. Nothing contained in this clause. Give me a sec. Let me use a different ink. Yeah. Nothing contained in this clause. This clause meaning clause number 10, 10D. That means section 10, clause 10D. Nothing contained in this clause, exemption will not apply for any unit linked insurance policy issued on or after 1st of February 2021 if the premium amount for any year exceeds 2,50,000. So the fourth proviso is saying that if you have this type of a policy where the premium is about 2,50,000, then assessee, when you get your lump sum amount from this unit linked insurance policy, section 10 clause number 10D, this exemption is not available, which means it is taxable. Now government is smart enough to know that people can find a loophole, people can find a breakthrough in this also. Fourth proviso is saying the premium for this policy should not exceed 2,50,000. If it exceeds, then you will not get exemption. So what I can do is I can go to 5 different insurance companies, and going to 5 different insurance companies, I can purchase 5 different ULIPs, and every time the amount that I pay will be below 2,50,000. So for each policy, the fourth proviso will not apply. I will take exemption for each policy, but the total amount that I'm paying in a year is about 2,50,000. Government knows that people can do like this. So it has created the fifth proviso also. If the premium is payable for more than one unit linked insurance policy. Now we are talking about a situation where multiple policies are being thought of. The provisions of this clause shall apply. 1 minute. You will get exemption. The provisions of this clause, section 10, clause number 10D, shall apply only with respect to those unit linked insurance policies where the aggregate amount of premium does not exceed the amount referred to in the fourth proviso. What is the amount referred to in the fourth proviso? 2,50,000. All those policies where the total premium for that policy, yearly amounts, yearly premiums totaled up together is up to 2,50,000. Assessee, go ahead, take your exemption under 1010D. If you have taken exemption, if you have taken multiple ULIPs, multiple policies, amount received from all those policies where up to 2,50,000 yearly premium was paid, exempt. That means balance policies, the amount received will be taxable. So if you try to defeat the fourth proviso by taking multiple policies, the fifth proviso will come into picture. Extra policies. What do I mean by extra policies? Those policies where the premium for those is about 2,50,000. That money is taxable. Amounts received from those unit linked insurance policies where the yearly premium is up to 2,50,000, enjoy your exemption. Balance policies, amount received will become taxable. Then the sixth proviso says, fourth and the fifth proviso shall not apply if it is received on death of a person. So, what does this mean? By on death of a person, no taxability. Exemption under 1010D will apply in all cases. Whether your premium was below 2.5, above 2.5, whether it was a single policy, multiple policies, if you are receiving money on death, that means the money will be received by the legal heir. Legal heir getting the money on death of the person, exemption will be available. That means this taxability is only with reference to the redemption, the maturity. Death pay you will get exemption. That means number one, we have established that amount received from unit linked insurance policies will be taxable if the yearly premium exceeds 2.5 lakhs. Step 2, moment you say it is taxable, next question arises, under what head of income will I pay tax? Second amendment, in the definition of capital asset. The definition of capital asset under 2 clause number 14. Any unit linked insurance policy to which the exemption under 1010D is not applicable. Why? Because of fourth and fifth proviso. That means we are establishing one thing, that the head of income here is going to be capital gain. So step 1, we decided no exemption, taxable. Step 2, we decided head of income, capital gains. Step 3, how to compute, how to calculate the profit. Now in the chapter of capital gains, section number 45, subsection 1b introduced. If any person receives at any time during any previous year any amount under a unit linked insurance policy, but that is covered by the fourth and the fifth provisos, then it shall be chargeable to income tax under the head capital gains and shall be deemed to be income of such person in the year in which the amount was received, and it shall be calculated in the manner prescribed. Problem remaining the same, no method has been prescribed so far. Then how do we find the taxable thing? Okay, there is a solution. We can still find the amount taxable. Observe this. Amount under a unit linked insurance policy where fourth and the fifth proviso to section 1010D apply. Units of ULIP are not included in the definition of transfer if it is received by government under section 2 clause 47. Okay, Punanjay, are you talking about compulsory acquisition done by the government? I don't think so. Are you talking about government issuing the units? Government issuing the units See, government will never do compulsory acquisition of units. Na? Units are listed on the stock exchange. So government is not going to do compulsory acquisition of those units. And government itself will never buy units. Na? Why does government need life insurance? So an individual needs life insurance. So me and you as individuals, we will purchase unit linked insurance policy. Now talking of every other possibility, a government company which is doing insurance, example LIC, that is different from government. LIC can issue ULIP policies, and then under the ULIP policy, units will be covered. Ultimately, the person paying tax under capital gains is an individual like you and me. So this whole thing is becoming taxable for the person who purchases the policy, a individual like us who is buying the policy, but the whole idea is to make investment. Got it, beta? Okay. Now, to wrap up this amendment, I'll be discussing 3 examples with you. Example 1. Say I have purchased a ULIP where the premium that I'm paying is 3 lakh rupees every year. The term of this ULIP is, let us say, 10 years. And on redemption, I am getting 50 lakhs. Now, please understand. It's a capital asset that we are talking about. Units of unit linked insurance policy. It's a capital asset. Concept number 1. Premium is about 2 lakh 50. So 10, 10D, fourth proviso will get attracted. So no exemption. You're going to pay tax. Now, they are units of unit linked insurance policy. They are units. So it's a capital asset. And let us make an assumption in my sum that they are equity oriented units. So if they are equity oriented units, what will now happen is holding period of those units up to 12 months is a short term capital asset. Holding period greater than 12 months is a long term capital asset. Now I will have to bifurcate all my units which are allotted to me in year number 1 to year number 9 are held for more than 12 months. That means these are long term capital assets. And if they are long term capital assets, yes, head of income is definitely capital gains. But if they are equity oriented, then section 112A will apply. And when section 112A applies, there will be no benefit of indexation available. So my computation will look like full value of consideration, that is NAV of the units at the time of redemption multiplied by all the units that were allotted to me from year number 1 to year number 9 minus cost of acquisition. I was investing 3 lakh rupees every year and I was getting units. So 3 lakh rupees given in year number 1, I got certain units. 3 lakh rupees in year number 2, I got certain units. Like this, every year 3 lakh rupees was paid. So for 9 years, 3 lakh into 9 years, my cost of acquisition will be 27 lakhs. And of course, there will be no indexation. This will be the long-term capital gain. And since we are going to cover it under 112A, there is an exemption of 1 lakh rupees. And it is only the balance amount of long-term capital gain which will be taxable. On this balance amount, after claiming an exemption of 1 lakh, on this balance, I will pay tax at the rate of 10%. And this is the tax payable under section 112A. But let's come back to our example. The policy term was 10 years. So which implies that the units which are allotted in the 10th year, their holding period is only 12 months. And that means if it's only 12 months, they are a short-term capital asset. And if they are a short-term capital asset, equity-oriented, section 111A will apply, where the tax rate will be 15%. So now my computation will be full value of consideration, which is NAV of the units on redemption multiplied by the number of units which were allotted in the 10th year minus cost of acquisition, the 10th year investment 3 lakhs. Of course, it is short term, so there is no question of any indexation. This is the short term capital gain which is taxable. And on this, I will pay tax of 15%, and this is the tax payable. The whole reason of taking such a detailed example is to make you guys understand that since they are now held as a capital asset, and for every year I will get different number of units. Number of units will be allotted according to the prevailing NAV. So, based on the number of units, my calculations will have to be done as short term or long term. This is example number 1. Let's say if I take up the same example with a slight difference, example number 2, I say they are the same facts as example 1, but with a small change that they are debt oriented fund. Now 2 changes will happen. 1, holding period up to 36 months short term, which means last 3 years ka units will be short term. Holding period greater than 36 months long term, which means the initial years all the units will be long term. I'm taking the same facts as example number 1. So 10 years. First 7 years units are long term. 8th, 9th and 10th year units are short term. Second change, short term capital gain section 111A will not apply. So regular tax rates will apply. Long term capital gain, since it is not equity oriented, 112A will not apply. So long term will be taxable under section 112. And under section 112, you will pay tax at the rate of 20% after allowing the benefit of indexation. Computation definitely will go in the same system. Third and the last example. Third and the last example that I want to take up is an example of multiple ULIPs. What if a person has purchased multiple policies? Say policy number A, for which he is paying a premium of say 1 lakh rupees. The term of the policy is say 9 years, and the redemption amount that he is getting is say 12 lakhs. Policy number B, he is paying a premium of 1,40,000. Term 9 years. And for this, he is getting an amount of 20 lakhs. And policy number C, where he's paying a premium of 90,000 for 9 years, and the amount that he's getting is, let's say, 9 lakhs. Now, what is the fifth proviso saying? The moment I talk of multiple ULIPs, fifth proviso will come into picture. And what is the fifth proviso saying? Up to 2,50,000 ka premium, those policies will be exempted. So now I will have various combinations. If I take combination A plus B, the total premium is 2,40,000 yearly amount. But the redemption money that I am getting is 10 plus 12, 32 lakhs. So if I take policy A and policy B for exemption, then 32 lakhs will be exempt. But I can go for a combination of A plus C, where the premium yearly is 1,90,000 and 12 plus 9, 21 lakh will be exempt. Obviously, it means the balance remaining policy, it will become taxable. Or I can also go for an option of B plus C. And in B plus C, the premium total is 2,30,000, which is still within the limit of 250, by the way. And the B plus C combination gives me a redemption money of 29 lakhs. Of course, if I total all of them, A plus B plus C, then it will exceed 2,50,000. So that combination is not possible. Now observe this. It makes sense for me to select option number A and B, this combination, which means I will get 32 lakh rupees of exemption. And under this, maybe if I can write down, then what will be taxable? Policy number C ka amount will be taxable, which is 9 lakhs. If A plus C is the option selected, then policy number B ka amount is taxable, which is 20 lakhs. And if combination B plus C is selected, then policy A ka amount is taxable, which is 12. So obviously, it makes sense for me to go for the first combination. It means my answer will be that A plus B, this amount is claimed as exempt under 1010D, and policy C ka amount is offered to tax, which will be taxable as capital gains. Now I will check what is policy number C. If policy number C is equity oriented, then do the computation as per example 1. If policy number C is debt oriented, then do the computation as per example number 2. So this is your entire, this is the set of amendments that I am discussing in this lecture. 10.5 leave travel concession, 10.11, 10.12, 10.11, 10.12, which is Provident Fund, Provident Fund, Public Provident Fund, Statutory Fund, Recognized Provident Fund, the interest component, and 10.10D, the ULIP discussion. If you can allow me a minute, I'll just put up this PDF in the Google Drive as a Google Drive link, and so that I can I'll share that link in the chat box so anybody can download that also. Just give me a second, please. House property as a head of income? No, beta. There is no amendment under the head house property. There is no amendment under house property. Just a second, guys. here, this is the link. You guys can download this PDF that you can see on in the lecture that I've used. You can download it. ULIP thing, I have analyzed it further also. I've printed some theory, so you can go through it. So as far as this lecture is concerned, this is all from my side. The second session that I take up from 3 o'clock, that is specifically going to be talking about CA final amendments. I'm going to take up some sections which will be exclusively CA final only. So Punanjay, that will be a CA final lecture. So you can skip attending that, your CA Enter student. You can download this PDF and you can study it. Any doubt you have, you can ask me in this chat box only, or there is a there is a Telegram channel by my name. This is the name. So you can join in the Telegram channel. You can ask me on Telegram also. So that's it from me. Part 1, CA Inter and CA Final Amendments both. Part 2, which the second session at 3 o'clock that I will be having, that will be only talking about amendments relating to CA Final. Chalo. Hope to catch you up, guys. Hope this lecture was helpful for you. Goodbye.